Time for our ETF Spotlight. We're going to focus on the financial sector. It is on pace for its best month since November of 2016. JP Morgan Chase's CEO Jamie Dimon was on CNBC earlier today in Davos, speaking about the health of the U.S. financial system. Take a listen.
3.5% global growth. The United States is doing fine. Trade may get resolved, and all those things may reverse. I mean, we're going to have a recession one day. We're adults. We should all understand that. And we don't know exactly what's going to cause the next one or exactly what the timetable is, but the financial system's in far better shape in the United States.
Mike Santoli, he's an adult also. He's got a closer look at the financials this morning.
I also expect someday a recession. Who knows? I mean, the financials, I think basically the market pretty much agrees with what Jamie Dimon just said right there, at least in the last month or so, which means we still have to be worried ultimately about credit costs going up, about growth slowing down, about loan demand eventually, but we were too worried about it a month ago or 5 weeks ago. So if you look right here in the last month, the various ETFs that cover financials, the XLF, keep in mind, it's much broader than banks. Berkshire Hathaway is the biggest holdings, a lot of insurance companies in there as well, up 12.5%. But you see the KBE, the major banks of the S&P, as well as the KRE, the regionals, up about 17% in the last 1 month. But look at 1 year, and you'll see that they're still down a whole lot more than the broad market is, because there was a sense late last year that the market was kind of over discounting or kind of in a panicky way saying things were going to go bad. Flat yield curve, perhaps recession near term, and then also, you know, what's happening with credit. So at this point, I feel like the market's comfortable saying these stocks got too cheap. It makes sense that they bounced, but where do we go from here? It's unclear. They did hold up pretty well yesterday, which was kind of interesting as the broader market had a big loss. But I think it's kind of, they're in the same position in an exaggerated way where the whole market is. Bounced really strongly. Now what?
I always think it's interesting when you look at the composition of these ETFs. I always learn something, because as an investor out there, I want to play the banks, XLF, but then you're getting Berkshire, which I would assume is a pretty heavily weighted.
It's like 11 or 12% of it. It's kind of crazy. It's a $500 billion company, keep in mind, almost. And of course, it's a lot more than financials in there. I don't know where else you'd put it in the S&P. That's the whole thing.
Right.
It's not really industrial conglomerate. So yes, the XLF, it gets the big trade. It's a huge part of the S&P, but it's not really banks.
Trying to remember what's more levered to financials, the Russell or the S&P?
The Russell is more level, it has a higher financials weighting than the S&P. Obviously, it's mostly smaller banks and smaller finance companies and things like that, as opposed to the global banks.
Is the thinking that once we move into Q1 results, that the story will be, did trading rebound, did loan growth rebound, or something else?
I think that'll be exactly it. Yeah, I mean, essentially, and you know, if we're in a 2.5% economy, the banks are probably fine with that. The yield curve is not widening out very much, but it seems almost as if at these valuations, the market has kind of made its peace with that probability. But definitely, there was a kind of collective decision to say, well, fourth quarter trading results, let's kind of put those aside, we'll wipe those away and just assume things are going to rebound somewhat here.
Although I don't know how this move compares to others so far. We're not even a month in terms of the financials. Do you? I mean, is it comparable in any way to a particular period we've had?
I mean, look, the best performance since November of 2016. November of 2016 was this huge just step function after the election, saying the whole world has changed. We're no longer fearing deflation. The yield curve widened out. We got deregulation coming. I don't know that storyline kind of persists, right? If you probably got whatever deregulation you're going to get, and capital levels are fine. I just feel like the banks we're discovering are no longer as levered to economic growth as they used to be, right? Because they hold more capital, they're not as leveraged, doing a little bit less.